the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Brought to you by NYSHEX, helping you deliver through volatility.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how you doing?
Fine here. Thank you very much.
Awesome. And we also have Rich joining us today, as tomorrow is a really big day for the industry in that the Intercontinental Exchange, or ICE, will be launching the container freight futures that are tied to NYFI. So in honor of the occasion, we thought we'd switch it up a little bit. So today's episode will be a little different. We're going to do a deep dive into freight futures and hedging. And to be honest, this is one of those topics where a lot of people nod along, but they might not fully understand how it actually works. I can relate to this at times. Rich heads up the NYSHEX financial products, including the indices, index-linked contracts, and futures. And he joined NYSHEX after over a decade in global commodities and freight derivatives, most recently as the head of business development for global commodities at the European Energy Exchange. Prior to that, he held leadership roles in product sales and strategy at Cleartrade Exchange and Maersk. So, Rich, obviously, tomorrow's a big day for NYSHEX and the NYFI. Why is the futures launch an important day for the industry overall?
Yeah, I think it's a really important day for the industry because this launch really shows how demand for futures and derivatives overall has grown in the container industry over the course of the last few years. So I was part of the first iteration of container freight futures back in 2011 and 2012. And back then, futures were not accepted at all. There was a lot of resistance, and even mentioning the word hedging could get you thrown out of someone's office. I'm exaggerating a little bit, but certainly these were not popular tools. Now, with the NYFI, we built that specifically to power index-linked contracting and hedging. We developed the index with a consortium representing all industry users, carriers, shippers, MVOCCs, and all of the organizations involved had the objective of building a new set of benchmarks that they could trust that would add value to the industry through using these tools. To be part of such a collaboration has been a great experience, but it really shows that now the industry is ready to look at risk management in a different way. And for me, it's really exciting to be involved.
If I can just jump in with a comment here. I was also, at least peripherally, around there back when the first attempt at launching freight future agreement and hedging tools was being done back there, basically just in the tailwind of what was the financial crisis back then. And for me, one of the interesting parts of the launch we're seeing now is also just to answer the question, what is different? Because I see that as one very fundamental thing that is different, the sheer magnitude of the rate volatility we face with. I mean, when we look back then, we thought a rate change of a few $100s from week to week was massive. And when we saw the huge wave, first the drop into the financial crisis and then the increase, you were looking changes at maybe a couple $1,000s. Contrast that with the development we've seen over the last 6 years. In terms of what happened with the pandemic, we had the Ever Given that got stuck in the Suez Canal, we got the Red Sea, we got the Middle East, and we are highly likely to see more similar crises erupt going forward. So the key thing that has really changed compared to 15 years ago is the sheer magnitude. And that is why it is so much more important to be able to also manage that risk.
Yeah, I think that's a good point. People think that this is a new concept and it's been around, but I think the need for it has definitely changed over the years. So Rich, let me ask you, in the months leading up to the launch, I'm sure you've had many conversations with folks about futures contracts. What do people misunderstand the most about hedging?
There's a few aspects, and certainly currently at the moment in the industry, understanding is not broad. But one of the questions I get a lot, and some of the terms I hear, and something that I really wanted to clarify and clear up a little bit, is around people asking me, what happens if I'm winning or losing on my hedge? And I think that's something that we should clarify. Hedging to manage risk is about trading uncertainty in the future for certainty. So of course you can end up protecting yourself at a time when, it turns out in the market that you didn't have the risk that you thought you did, but that's really no different from physical contracting. If you were to sign a fixed rate contract, it performed all year, it was honored, you moved all your cargo, but at the end of the year, you assessed it and you were $200 above the market, but you had that 100% price predictability. Would you consider that losing? I think most organizations in this market, unless they're particularly price sensitive, would not. And so when it comes to hedging and derivatives, that's the one big one I want to counter. You shouldn't think about winning and losing. You should think about trading uncertainty for certainty.
Just to add a couple of things, maybe also to put people in the right frame of mind, let me make a perhaps somewhat silly example here, but you take out a fire insurance on your house, and 6 months later, your house burns down and you get a payout of $2 million. Have you now won? I'm not quite sure that's how you would tend to see it. Or if you have your fire insurance for 15 years and your house never burns, have you been lost because of everything you paid? Winning or losing is not really the perspective that's the appropriate one here. And the one thing I would tend to point to also that I've come across quite a few times is the misperception that that goes both for the hedges and also for the index-linked contracts, that you must then pay exactly the rate the index says, or exactly the rate that is now set. There is nothing wrong in trading at an offset. You can be trading at 10% below, at 50% below, at $50 below, $200 above. That the actual number is not the important thing. It's tracking that index and locking in where you want to be. It's not this specific number that tells you you must be locked in at that level.
Yeah, excellent points. I think something else that maybe not everyone knows is that if you have a futures contract, you're not necessarily moving containers against the futures contract. It's not a contract for the physical carriage of containers. Freight futures are a totally separate mechanism from your freight contracts. Is that right, Rich?
That's absolutely right. And that's actually one of the most common questions that we get asked when we start talking to people about this concept for the very first time. Is they ask questions around, so how does my carrier know that I've locked this rate in? And that's not how it works. The futures contracts are transacted in the financial market. It's completely separate from the physical contracting relationship that actually moves cargo, and all settlements in that market are in cash. No, when you have this type of futures contract, it never ends up in somebody shipping a box.
So why would someone trade freight futures?
So freight futures are used to offset risk, and specifically the risk that freight rates will move in a direction which is unfavorable for your business. So if we take the example of a shipper, you may want to offset the risk that higher rates in the future will increase your landed cost. And that's what it's all about. It's just about creating a position which gives you the opposite of an unfavorable move in the physical shipping market.
Okay, so it's not at all managed with your carriers directly, and it shouldn't interfere with the way that if I'm procuring freight, it wouldn't interfere with that.
No, absolutely not. So the financial market, it's complementary to the physical market because of the way that you can use the two to offset risk. But as I say, it's completely separate from the market. We, as NYSHEX, we did a futures workshop in Hamburg just a week or so ago. And one of the people in the audience there came up with the perfect phrase to say, this is decoupling. This is decoupling from the physical market. And that's exactly right. It's totally separate.
That's a good way to think about it.
Usually when we sit over on the freight department, the people in the supply chain, they are somewhat insulated from what happens over at typically the CFO's office. But in the CFO's office in many larger companies, they are happily using these tools to manage interest rate risk, currency risk, and also other certain risks. But because they're managing, say, for example, currency risks, that doesn't mean that they are physically now buying yen by the stack and putting them in a drawer somewhere else. That's also purely a financial transaction.
Yeah, that's a good analogy. Rich, what are some of the other industries that trade futures?
In futures, or if we were to give it a kind of broader description, managing risk with derivative contracts is widespread in many industries. It's common practice in a lot of industries. We could look at everything from other shipping modes. This is very broadly used in tramp shipping, like dry bulk, wet bulk markets, and even in the LNG freight market. It is absolutely commonplace in virtually all commodity markets, whether it's grains or oils or metal. And of course, with the example that Lars gave in currency and other financial markets, this is common practice as well. So it's very broadly used in many industries.
Okay, so can you do some term clarification for us? Like when people mention hedging, is that the same as trading futures? Is it part of it?
Yeah, absolutely. So hedging just means managing risk to keep it really simple. And there are many ways to do that. And futures are just one tool that you can use to manage risk. A fixed rate long-term contract is in itself also a form of hedging, right? So hedging is just risk management. The term trading means buying or selling. And when you add these together, it starts to sound a little bit exotic, right? We're trading futures. But really, if we decode it, it just means managing risk by buying or selling a financial contract.
Yeah, I think once we get through the terminology and the understanding, it's a bit easier to follow, but it is a bit intimidating, I will say. So now that we've gone over the basics here, let's talk about a couple of scenarios where someone in the container industry might want to hedge.
Okay, again, let's start with the shipper example, the shipper perspective. So if I'm a shipper and I'm moving cargo and I have exposure to the spot market, I'm either moving at spot rates or I have an index linked contract, I can buy futures to hedge against the risk that prices are going to increase and therefore my costs will increase. Financial contracts like futures, they're guaranteed to be executed. So once your hedge is in place, you know it will be honored, but they're also very flexible. So you can hedge different amounts of your cargo volume. You can hedge different periods ranging from a single month to multiple years and anything in between. You can move hedges in time. You can close them if you no longer need them. So they're quite flexible. So to bring it back to the example, I'm a shipper. I'm concerned that rates are going to go up in peak season, which they frequently do. I can hedge just those months that cover the peak season and I can float with the market the rest of the time. If peak season looks like starting earlier, I can pull my hedge forward in time. If it's starting later, I can push it back. If it looks like there's not going to be demand and peak season is really flat, I can close my hedge altogether. So that's one example. You can use it to offset the risk that prices are going to increase in the future. Conversely, the example from the carrier perspective is covering the risk that rates are going down in the future. You can very clearly see from the earnings reports of carriers just how price sensitive they are to the spot market. They can protect revenue by selling futures. And that means that if prices go down in the future, they get a cash offset from the financial market, which helps to lock their rates in at a higher level. Where it gets really interesting for me particularly is with the MVOCCs or the freight forwarders. Because of the nature of their business, they are already trading freight, so to call it, all day, every day. You know, they're buying, they're selling. Sometimes they're selling things they haven't bought. Sometimes they're buying things they haven't sold. And so they have risk often in both directions. They may want to buy or sell futures at different times. They could even use futures to build new products for their clients, or they can create structures which safeguard their margins, particularly in falling markets. The shipper example is quite obvious. The carrier example is quite obvious. There are other examples they can use as well. And then when it comes to the MVOCCs, really there's a huge amount of flexibility that they can achieve through these tools.
Yeah, another obvious case on usage is if you're a shipper and you might have a client that comes to you and say, look, we want to buy a huge quantity of your goods, but we only want to buy it 6 months into the future, and we need you to provide a price including freight. And in that case, you have the perfect tool at your fingertips as well. Because if there's one thing you don't control right now, it's what's the freight rate going to be 6 months from now. In this case, you can provide the freight quote because you know you can lock that in no matter what then happens in the spot market later on. This is particularly useful if you are shipping goods that are huge in volume but relatively low in value.
Yeah, that's a great example. And we see that a lot in commodity markets, particularly in other modes, especially where people can already hedge the price of the commodity, and the shipping is the element which is really still open to the risk. And often that prevents them doing exactly what you say of selling forward a long way because of the potential escalation in shipping prices that they can't manage. So that's another good example. Thanks, Lars.
If I'm interested in having a futures contract, who do I talk to? Do I talk to a broker, my bank?
Yeah, talk to all of us. But really, the answer to that depends a little bit where you are in the process, right? The first step is education and understanding. NYSHEX, we can help with that either through our NYSHEX Academy, or we can introduce you to some of our banking or broking partners. Feel free to reach out to us at NYSHEX, and we'll certainly help to put you in contact with the right people.
So it sounds like I'd need to have an account at least set up with the bank point here.
Yes, you absolutely will do. It's not your kind of high street bank account. Banks provide specialized services for access to financial markets, but yes, you will need to set up with a bank so that you have all of the proper account structure in place.
Okay. And how long does that normally take? Can I just buy a futures contract today?
Not unless you're already set up. So the setup process does take some time. It can take several months. It could even take longer. Financial markets and the banks and the brokers that provide services in them are highly regulated markets. And so there's several steps to opening an account. They will do know your customer, anti-money laundering and other checks as well. So it does take time to provide that information and go through all of those steps to get your account set up.
Okay. And so you mentioned before the price curve. And so where can I actually see the futures prices?
Yeah, so you can see them in a variety of places at different times. There is this end of day price every day, which is often used for the daily settlement. And that covers a price for every futures contract and every expiry. So for the NYFI contracts, there's 4 of them and there's 36 monthly expiries. So you would see a price for all of those expiries in all 4 contracts. So you can find those on our NYSHEX platform. You'll also be able to get them directly from the Intercontinental Exchange. You can get them from your bank or broking partner, and they're also available on the kind of major data vendors, so the Bloombergs, Refinitives, and others. Banks and brokers, they'll also be able to give you intraday pricing. So when the market is liquid and trading a lot, prices move around in the day. So they'll be able to show you the latest bids, offers, and traded levels for all of those periods. So really, there's a lot of information out there. You can get access to it quite easily.
Okay. And if I want to explore this option, how do I decide what price to lock in?
That's a great question. I'm going to swerve the answer a little bit and say it's completely up to each organization. And it depends what you want to achieve from the trade. So there's not necessarily a right or a wrong level to lock in. The prices that you'll be able to transact at will be a function of the market and where the market's already trading. But exactly how hard you need to negotiate and what price you need to lock in is going to be based on your objective and also how price sensitive you are as an organization. So it's not dissimilar from how you'd agree a price in the physical market.
What I would tend to add in there is also it creates a new interesting dynamic. What I've seen over the years, usually in my role as advising also on the shipper side, I will quite often come across let's call it a frustrated supply chain manager who says, what's going to be the average market rate over the next calendar year? Because he's being pressured by his CFO to put this into the budget. And very often we end up having a conversation that number doesn't necessarily make a lot of sense because it is highly volatile. With this approach, the supply chain manager now has an additional tool in the toolbox because he can then look and say, fine, right now, this is where the forward market is. So he could more proactively go back to the CFO and say, here are the options we can do. We can either go out and pitch it right now. I can actually give you a completely solid budget number because this is then going to be it. If we then, for budgetary reasons, don't like that number, then that's fine. Then we can look at other options, but it grounds that discussion more in hard fact than what it actually is now.
Yeah, that's such a good point. I hear that a lot from our clients that there are people stepping in that want to know what to expect over the next year, but we've seen over the last few years that it's just so volatile you can't have any idea of knowing. But now I think with the forward prices, you can have at least a sense of where generally the people in the market think that the rates are going.
Yeah, and everyone would love to have a crystal ball, wouldn't they? And if we could do that, I guess none of us would need to be sat here today. But I like the way you articulated that, Lars, right? People want to know what's happening in the future. We can never tell you exactly what's going to happen in the future, but you can look at the forward curve and decide your own destiny, because those rates show you where you can lock in today for those different periods.
So, Rich, should I hedge 100% of my volume? Should I just do a portion? What would be recommended, especially as a first-time person engaging in this?
Yes, again, it's something that's different for each organization and linked to their kind of risk management strategy. So different organizations will want to hedge more or less depending on how kind of risk averse they are. People should remember, though, that futures contracts are 100% binding. As I said, you can alter your position. It can be changed, but that does potentially come with a cost as well. So when you place a hedge, as I said, we're trying to trade uncertainty for certainty. So if you do that for 100% of your volume, that locks everything into a single outcome. And so common practice is really that people tend to hedge different proportions of their business for different periods into the future, generally with less volume hedged further into the future than closer to where we are right now. And then they adjust that over time to increase or decrease the amount of volume that they have. So it's really very flexible. Again, it depends on your risk outlook as an organization. But do remember, if you do 100%, then you've locked in the result for 100% of your volume.
Is there maybe a minimum view count that you would need in order to hedge?
Yeah, so there are minimum contracts amounts. So the contracts, the Intercontinental Exchange will have a minimum volume of 10 FEU. So that's the smallest size that you can do in one clip, one trade, but it's not per expiry. So you could do that over 3 expiries in a quarter or something like that. So you can start with really quite small volume if you're just dipping your toe in the water.
Yeah, figure out how everything works. I think that would maybe be a good approach.
Exactly.
Okay. So let's talk a little bit about what it actually looks like to place a trade. Could you walk me through that?
Yeah, so placing a trade means that you have agreed a contract, and it will have, of course, a specific price, a specific volume. It will be for a specific contract, which in this market is geographical route. So let's say Asia to the US West Coast, and it will be for a specific time in the future or a group of times. So it could be an April contract, it could be a Q3 contract for 2026. It could be what we call a calendar contract, which is a whole year for 2027, or any combination in between. But it will be all of those factors fixed in advance. Once you've done your trade, you'll get a trade recap from your broker or your bank, which shows you the details of the deal that you've just done. And depending on exactly how you're doing that trade and who you're doing it with, you will see it in your position account as well.
Okay, cool. And how, if we think about the companies that are engaging in this, they're probably also moving physical shipments. How does it connect to the physical shipments?
So as we said at the beginning, it doesn't technically connect, it's complementary. These are two entirely separate markets. So how it really relates is that we use the cash settlement from the financial market to offset any unfavorable price move in the physical market. So they do connect to each other, but they're not technically linked. If I'm, again, the shipper, if my rate goes up in the physical market, I pay my carrier more. One way, I'm out of pocket on my physical shipment, but I get the same cash back from the financial market. So let's say the physical price goes up $500. I'm paying the carrier $500 more to move my cargo, but I'm getting $500 back from the financial market. And the net result of the two is flat. So there's no cost increase. So that's how they link together.
Yeah, that makes sense. And the carrier doesn't necessarily need to know that I hedged.
Absolutely not. You may want to set up an index link contract with them in a way that allows easy hedging for you. But no, they don't need to know. You don't have to tell them. And generally, financial markets are completely anonymous. And especially when they're exchange traded and cleared. Again, if we do a deal together, if the broker is in between facilitating that deal and negotiating it on our behalf, we never know who the counterparty on the other side is. And we don't need to, because everything is insured through that clearinghouse as the central counterparty.
And maybe also just an added comment also on the complementarity or link between the physical market and the paper market. I would tend to also look at it in a much more simplistic way. It's the physical market that keeps this grounded in reality. Because at the end of the day, it's the physical movement that ends up also settling what was the actual price of moving a box from point A to point B. And 15 years ago, when there were attempts at this, some of the criticism back then, I would tend to say maybe by people at the time didn't quite necessarily understand what this was all about. What's maybe likening this just becomes a casino where you don't know what anything is worth. But that's exactly where the physical movements then come in, because speculation cannot really run wild at the end of the day, because once the contract reaches their expiration, the prices will be determined by what actually happens in the physical market.
At the end of the quarter, if I have a quarterly futures contract, what is actually happening?
Yeah, so all of the NYFI futures contracts are monthly. So you can trade them as a single month, you can trade them as a strip of months. People often bundle them up into quarters and calendars. If you trade a quarter contract, what you get is 3 monthly contracts at the same price and volume. And then they will settle at the end of each month. So if we trade a Q4 contract, for example, at $2,000 and 100 FEU per month, then what we really get is an October contract at $2,000 and 100 FEU, a November contract for the same, and a December contract for the same. And so then at the end of October, the October contract will settle. You'll realize whatever profit and loss you have on that contract. And then you'll have November and December still open, and that process then repeats itself as you move through the quarter.
And then how do I determine if my hedge worked?
So this is another great question, and it goes a little bit back to the kind of winning and losing debate. So the way to determine whether your hedge worked or not is whether it achieved the objective that you set when you entered into the trade. So if you hedge to achieve a net fixed rate, did the hedge deliver that net fixed rate for you? If it did, then probably achieved its objective and it worked. If it didn't, for whatever reason, then it didn't work. So the way to look at it is, what do you want to achieve? Is your hedging and risk management program achieving its aims? And that's how you know whether it's working or not working.
I think a lot of people probably assume that they need to loop in other people within their organization. And we talked a little bit previously about the financial side of your organization may already be doing this in various capacities, but do you think people should go ahead and talk to their CFO about this if it's something that they think would be beneficial for their organization? Is that sort of a good next step internally to take?
Absolutely. And we talk to a lot of people about linking the logistics or sea freight side of their organization with their treasury or CFO function. For this to work really well, you need both sides. So the treasury and CFO teams, they will understand financial contracts and hedging. As Lars said, they'll be doing this on their currencies, on their interest rates, things like that, maybe even in other commodities as well. But of course, the sea freight team, they know about sea freight, they know about the market, they know where the market is, what's coming, what they need to achieve, how they need to ensure their supply chain. It's a great step, I think, to get together internally and start to discuss these things, because then you can really cross-pollinate across those different expertise verticals within the organization.
And as people start to do this, you're going to have a lot of novices. What do we generally see are the mistakes that people make when they first start?
So I think probably the biggest mistake, or maybe it's not a mistake, maybe it's just a kind of misconception, or maybe being a little bit too ambitious, it's just putting a bit too much pressure on your hedge. We talked earlier about testing the pipes, getting to know how every step of the process works. Like any new business process, you'll need to test this when you first do it in your organization, possibly with one trade, possibly with a number of small trades. But you need to understand how this kind of works in reality, right? I would say that's one of the kind of classic mistakes, saying, we're going to do this. This is the outcome we want to get, and putting a lot of pressure on that hedge to perform straight away before you really fully know what you're doing. It's maybe better just to do something small that tests the system, and then you can learn from that and then scale it up like you would do with any other new process in your business.
We've talked a lot in this episode about how everything works, why you would do it, why you wouldn't. It sounds like it's a very time-consuming process. Is that actually the case, or is it just as you're getting to figure it out, it's a bit of a learning curve?
Obviously, you have to invest the time up front to understand and learn it. There is an investment in time in terms of setting things up within your organization and setting up the relationships that you need. But these things are all done up front in the setup phase. In terms of whether running a hedging program is time consuming, that depends entirely on how comprehensive the program is. It may be that these can be managed alongside other processes within particular job roles, or if you want to have very comprehensive and large hedging program, then probably that needs dedicated professional traders to manage that for you. So again, it's one of these things of, I don't want to not give a definite answer, but it's going to be different for each organization.
So if I try this and the market goes the complete other way, what's the worst case scenario of what happens there?
So again, this kind of market going the other way question relates back to this winning or losing debate as well. So hedging is about managing risk. If you hedge to achieve a fixed rate and the market ends up above or below that fixed rate in a way where it would have just been more favorable for you to not have hedged, you could see that as a loss, but you could also classify it as hedging achieving its objective. You wanted a fixed rate and a fixed rate was what you got. We'll go back to the fixed rate contract example. Maybe you were above or below the market, but was it in a way that you would consider losing?
I think I may add another perspective here as well. You enter into a hedging position, and for the first month, it actually goes your way. And you go to the boss and say, look, I made us $100 per box. That is fantastic. The next month, it goes in the other direction. Oh my God, now you lost $200. We better get out of this. But if you're sitting as a shipper right now, let's say you're on a trade where the normal rate is, let's just call it $2,500. Rates could plummet $2,500, but it's not really going to drop anymore because then freight rates are zero. On the other hand, as we saw during the pandemic, rates can also go up 10x to 20, 25,000. So the risk perspective you're looking at here as shippers, what's your risk exposure? It is actually very skewed because it's limited how much benefit you can get from lower rates, but it is completely unlimited how much could rates increase. And for the listeners out there that now say, yeah, sure, that was a one-off, what we saw during the pandemic, where in some cases rates actually did go up 1,000%. We're never going to see that again. We thought during the financial crisis 15 years ago that was extreme. Then look what the pandemic brought us. During the pandemic, one of the comparisons I was making at the time was that this was the first time in container shipping we saw these wild price swings. But they were not uncommon in the bulkers and tankers market. And lo and behold, what have we been seeing here in recent weeks? We have suddenly seen tanker rates now exceed all historical records, even the ones we had during the Iran-Iraq war, the ones we had during the oil price crisis in the 70s. So whilst we certainly shouldn't hope that we're going to reach pandemic levels again, shippers need to realize they're facing a very skewed statistic. Their rates can at most drop $2,000, $3,000, depending on what their rates are, but they can basically go up infinitely depending on which geopolitical problems are thrown at.
Yeah, that's a super good point. Rich, we're wrapping up here, but I have just a couple more questions. If I'm a procurement manager and I'm listening to this and I'm curious, what's the first thing I should do?
The first thing you should do is reach out to some potential partners, right? Whether that's to further your understanding, if you're right at the beginning, or whether it's to start getting set up for trading. Us at NYSHEX, the banking and broking partners that we work with, everyone will be really happy to talk to new people and help them to take the first steps in this process. So we'll certainly help wherever we can. We're very happy to put you in touch with other partners, but I would say regardless of where you are in the chain, the first step is to reach out to a potential partner and start thinking about where you want to go next from the position that you're starting in.
Awesome. We didn't get to go through the NYFI movements this week. They haven't actually been released yet, so this is airing April 6th. Because of the Easter holiday, the new NYFI rates will be published tomorrow. So we'd like to encourage you to sign up for the free NYFI insights so that you can receive the rates either via email. You could log into the platform. So Rich, maybe another good question for you. How can our listeners sign up to see this?
So you can sign up completely for free on the NYSHEX platform. So simply go to our website, set up a username, you'll get access to the platform almost immediately. And then you can see in there all the latest index movements. You'll get them emailed to you directly. And you can now see all of the forward curves for the futures contracts in there too, which is another really interesting statistic to look at.
Perfect. All right, everyone. Thank you so much for tuning in. Next week, we'll be back with our regularly scheduled programming, but I hope everyone has an awesome week. And if you haven't already subscribed, be sure to on Apple Music, Spotify, or YouTube, wherever you watch. And that way you'll know when we release our episodes. Until then, I hope everyone has an awesome week. Bye, y'all.
Bye-bye.
Thanks for listening to the Supply Chain Secrets podcast, presented by NYSHEX. Be sure to subscribe on your favorite podcast app.